There's a financial account that gives you a tax deduction when you put money in, lets your money grow tax-free, and lets you take money out tax-free, all three, at once. It's called a health savings account, or HSA. And somehow, even people who are pretty financially savvy have never fully understood what it is or how powerful it can be. In this video, I'm going to break down exactly what an HSA is, who qualifies, how the triple tax benefit works, and why some finance experts call it the single best savings vehicle available to American workers. Let's get into it. Let's start with the basics. An HSA, health savings account, is a special savings account designed to help you pay for medical expenses. But it's so much more than just a medical fund. To open an HSA, you need to be enrolled in what's called a high-deductible health plan, or HDHP. These are health insurance plans with higher deductibles but lower monthly premiums. In 2025, the IRS defines a high-deductible plan as one with a deductible of at least $1,650 for an individual or $3,300 for a family. If your health plan meets that threshold, you're eligible to contribute to an HSA. And here's where the magic starts. The triple tax benefit. This is the reason financial advisors get excited about HSAs. Number 1, contributions are tax deductible. Every dollar you put into your HSA reduces your taxable income, just like a traditional 401k or IRA. If you're in the 22% tax bracket and you contribute $3,000, you just saved $660 in federal taxes. Number 2, your money grows tax-free. Once inside the HSA, you can invest your funds in mutual funds and index funds, and all that growth, dividends, capital gains, appreciation, is completely tax-free. Number 3, withdrawals are tax-free, but only if you use the money for qualified medical expenses. These include doctor visits, prescriptions, dental care, vision, mental health services, and hundreds of other eligible expenses. No other account in the U.S. tax code gives you all three of these benefits simultaneously. Let's compare this to a 401k. A traditional 401k gives you tax deductions going in, but you pay taxes on withdrawals in retirement. A Roth 401k gives you no deduction going in, but withdrawals are tax-free. An HSA gives you the deduction going in and tax-free growth and tax-free withdrawals for medical expenses. The only restriction is that withdrawals must be for qualified medical expenses to avoid taxes and penalties. But here's the critical piece most people miss. After age 65, you can withdraw from your HSA for any reason, just like a traditional IRA. You'll pay income tax on non-medical withdrawals after 65, but there's no penalty. This means your HSA essentially becomes a bonus retirement account once you hit 65. On top of all the tax-free medical withdrawals you can take at any age. Let's talk contribution limits. In 2025, the IRS allows you to contribute up to $4,300 for individual coverage or $8,550 for family coverage. If you're 55 or older, you get an additional $1,000 catch-up contribution, just like with IRAs. If your employer offers an HDHP with HSA access, many employers also contribute money to your HSA, basically free money on top of your own contributions. Always contribute at least enough to capture the full employer match if one exists. These limits reset every year, and unlike flexible spending accounts, FSAs, HSA funds roll over indefinitely. There is no use it or lose it deadline. The money stays in your account until you spend it, for as long as you live. Here's the strategy that most HSA holders completely miss: invest your HSA funds instead of just letting them sit in cash. Most people treat their HSA like a checking account. They deposit money and immediately use it for copays and prescriptions. That's fine if you need to, but you're leaving enormous value on the table. The smarter play, if you can afford it, is to pay your medical expenses out of pocket now, let your HSA money invest and compound in index funds, and then decades later, reimburse yourself for those old expenses. Critically, there's no time limit on reimbursement. The IRS just says the expense must have been incurred after you opened the HSA. So you could pay a $200 dentist bill today, save the receipt, and reimburse yourself in 20 years, completely tax-free, after your money has had 2 decades to grow. This reimbursement strategy turns the HSA into what some call a stealth IRA. You're essentially building a pool of future tax-free withdrawals that you can claim at any time by matching them to documented past medical expenses. The key is keeping meticulous records, save every receipt, explanation of benefits, and medical bill. A simple folder, physical or digital, is all you need. Then let the HSA compound. Over 20 or 30 years, the combination of tax deductions, tax-free growth, and the ability to reimburse old expenses could generate hundreds of thousands of dollars that were never touched by the IRS. Let me give you a concrete example. Say you open an HSA at 30 and contribute the full individual limit of $4,300 every year until age 65. That's 35 years of contributions. If you invest in a low-cost index fund averaging 7% annually, you'd accumulate roughly $590,000 in your HSA by 65. During that time, you pay medical costs out of pocket and keep the receipts. At 65, you can start pulling money out, tax-free for medical expenses, which in retirement are substantial. Studies show Americans spend an average of $315,000 on healthcare in retirement. Having a large HSA specifically for those costs means your other retirement accounts, your 401k and IRA, are free to cover everything else. Now, who should consider a high-deductible health plan and HSA? The math generally favors people who are relatively young and healthy, high earners who benefit most from the tax deduction, and people who have enough financial cushion to cover a higher deductible in a bad medical year. HDHPs are generally not ideal for people with frequent, expensive medical needs, like chronic conditions requiring regular specialist visits and medications. In those cases, a plan with a lower deductible and higher premium might cost less overall. Run the numbers for your specific situation, compare your expected annual medical costs under each plan plus the premium difference, then factor in the HSA tax savings. How do you actually open an HSA? If your employer offers an HDHP, they'll typically offer HSA access through a specific provider. You can also open an HSA independently at providers like Fidelity, Lively, or Health Equity. Fidelity's HSA in particular has no fees and offers excellent investment options. You contribute money, elect your investments, and manage it just like a brokerage account. Make sure you select actual investments, don't just leave the money in the default cash position. Most providers will show you a menu of mutual funds or ETFs. A simple total market index fund is a perfectly reasonable choice. A few things to know that trip people up. You cannot contribute to an HSA if you're enrolled in Medicare, so once you turn 65 and enroll in Medicare, contributions stop, but you can still spend the existing balance indefinitely. You also cannot contribute if someone claims you as a dependent on their taxes. And you cannot contribute to both an HSA and a full FSA in the same year, though a limited-purpose FSA for dental and vision only is allowed alongside an HSA. These are the main gotchas, but they affect a relatively small number of people. To wrap up, the HSA is arguably the most tax-efficient account available to Americans. Triple tax benefit, unlimited rollover, investment growth potential, and the flexibility to become a bonus retirement account after 65. If you're eligible, meaning you're on a qualifying high-deductible health plan, maximizing your HSA every year should be a top financial priority, right alongside your 401k match and Roth IRA contributions. If you're not sure whether your current health plan qualifies, check your plan documents or ask your HR department. It's one of those questions that could genuinely change your financial future. Subscribe if you want more content like this, and I'll see you in the next video.